Hey everybody, this is Jason Matthews. I want to talk about 1 week after the federal case cuts, I should say. This is a huge information, a lot going on in the world when we talk about this, about the Fed interest rates cuts. So, if nothing, you guys remember last week, I should say, I was on KTU, mornings on to last Thursday, talking about the changes we was going to see with interest rates due to Jerome Powell, the Federal Reserve, first time that they lowered rates in a couple of years after we'll be having this increase of interest rates. I think these are very, very interesting information. So this morning, what really got me on this and inspired me to make this video was this morning I went to the Central County Marketing Group it was in actually in Castro Valley. It's a room predominantly of people in the real estate industry, and they had this mortgage broker talking and discussing what does he see with all and he owns he owned a loan company. He was talking about what he sees in the marketplace and how he sees the effects that's going to possibly happen and what's going on, and where he sees things are really going and getting into. And what I want to do was just talk about my thoughts, what I heard from him, where I see things going, and how this all affects us. So when I went there to meeting, there's a couple of things we have to learn right now is that the Federal Reserve do not control long-term interest rates. They control the short-term interest rates. And what he was saying, and this is a great point, is right now, since the Federal Reserve lowered interest rates on the short term, long-term interest rates we're seeing right now for mortgages actually has risen ever since then. So right now, what people have to realize is that the bond market in the mortgage industry baked in interest rates cuts. And because of that, rates actually have dropped since April. But since interest rates, since the market increased, we actually see interest rates and 30-year mortgage actually increase. So what the Feds do when we talk about short-term rates and how this affects you, these are the things that we're seeing the drops in right now. One is HELOC loans. You're going to see credit card interest rates drop, money markets and short-term CDs and treasuries actually going to go for the short term are going to be dropped and lower. While what we're seeing in the long term, 10-year treasuries and 30-year mortgages actually go up. So here's an example of where we might see that. Let me make this screen actually a little bit bigger for you guys to see it. So if we look at the 30-year over the last week, let's make this a little bit bigger for you guys. And we look at last week on the 18th, we saw interest rates on the 13th and 14th at that time 3.65%, and now right now we see them at 3.74%. So even in the last week, we saw 10-year treasuries, which affects most long-term yields, actually go up. And that just lets people know that we are seeing interest rates creep back up. It's not as great as people thought it was going to see for as interest rates, that we're just going to go through this period of time where everything goes up. No, that is not true. What we saw that went up is long-term rates go up, but short-term rates did not go down. While people heard all this news that the Feds are cutting rates, things are happening, and people automatically assume all interest rates were going to go down, when reality is they only control that short period of time, right? So how can people take advantage of this? So if you're looking for a HELOC all this time, if you're looking for a HELOC, if you're trying to get a little breath in it, this might be a great time for you to go ahead and get a HELOC loan, look at your credit cards, see if there's anywhere else, and see if you can lower those rates on your HELOC. You see if you can lower your rates on your credit cards. Also, as we see this, if the rates eventually go down, the people who got a mortgage over the last couple of years, this might give them some breathing room just to and be able to refi. Now, this person, you always have to take a grain of salt on who perspective you're hearing and what's their motivation or inspiration on why they're talking. And he was telling people, go ahead, because there's less competition. We see home prices dropping here in the Bay Area, that you should go ahead and purchase a house now, knowing that rates are going to eventually go down later. And his reason being is this. One thing, we know people are borrowing to the tilt right now. We have lack of inventory, people borrowing to the tilt. So auto loans defaults are the worst they've been since 2008. Actually, the worst in the Great Recession. Also, we see credit card tilts right now. We see savings and times all-time low. And what he thinks and what his economists are saying is that the American people are actually tapped out right now. And because they're tapped out, what he sees is we're actually more and more in a recession because unemployment numbers went up. We don't see no more inflation. Because of that, he believes that the Federal Reserve want to cut interest rates all the way over the next 18 months till they get down to 2%. Now, if the Federal Reserve brings them down all the way down to 2%, he says at that point, we'll see 30-year mortgages go up, will be around that 4.5 to 5%, and that's when we give, and then with that, more people want to jump into the mortgage market and purchase mortgages. But at the same time, what he feels why they're doing that is we're heading into a recession, a great recession, which is crazy. So over the last, I read a report today talking about the Bay Area and how we had right now, you see in high-paying jobs in the Bay Area, Silicon Valley, that there actually has been layoffs. And because of those layoffs, people are not doing it as we expect them to be. And we actually, the Bay Area seems like we might be actually in a recession. And more, we're seeing this happen. So with that being said, I think right now this is just a time where you shouldn't get excited thinking that you're going to be able to refi right now. You're going to have to wait and see. You're still going to have to consider how to do a HELOC if you are. If you're an investor, you know that we're getting closer and closer to a time of a recession. Or if not, we are in a recession. So we have to prepare and plan. One thing when we're headed to recession is cut your credit cards down, lower that credit card limit, lower all your debt, plan, prepare as you might have layoffs, as we're already seeing a lot of layoffs already happening in San Francisco, in Silicon Valley as well. At the same time, look at your portfolio to see how it is. If you're closer towards retirement, look at guaranteed income, especially with these rates being higher in the long term. And now you don't have to put so much more money to get that guaranteed income for life. And then you can be a lot more aggressive with those funds. Anyways, I hope this helps out everybody on this talk. Just want to make a quick live stream today in the middle of the day for lunch. Talk to you later.